This is the Biz of Wealth. Challenges, rumblings, and evolution of the wealth management industry.
Welcome to Business of Wealth. Today I'm here with Karen Rands. Hi, Karen.
Hello, how are you, Alondra? It's great to be here. Excited about this.
Yes, me too. I've been talking to a couple of VCs lately, so I wanna, dig right in and talk about your profile first, where you come from. I see, we all see that you are very well-renowned author. So first, give me a quick overview of what got you here and what's here for you.
Okay, so I've been fascinated by the whole, like the spirit of entrepreneurism and innovation most of my life. You know, as a girl, I had this vision of what my life was going to be like when I was going to be traveling around, and I didn't even really know the term entrepreneur back then, but I just sort of had this idea. And then fast forward, after going through college and graduate school, and then I was in the corporate gig and with IBM, I found myself right at the beginning of the dot-com period working with a lot of companies that were those kind of companies that the evolution of technology had enabled. And in the IBM world, that would be, regular brick and mortar stores going online. We call them click and mortar. And then you also had, folks that were just, what we now call cloud computing. Back then was ASPs because they were not your client server. And you had just all kinds of different kind of innovation that was enabled because of things connecting. We didn't really have the internet quite the way, and the web interfaces quite like we have now, but there was a lot of this kind of stuff and businesses that were, because of the ability, the world becoming flat, so to speak, they were outsourcing virtual services overseas, and that was a really new thing. So I was a complex opportunity business manager that was helping these companies get their stuff together so that an IBM to approve, or like we called it the Betty Crocker seal of approval of their whatever their solution was. But the idea, they would go out and get venture capital money and comes back and spend it with IBM, because we kind of helped them validate, and then that would give them credo, because IBM realized they had missed out on a lot of the big boys as they were standardizing on somebody else that was more flexible for startups and early stage companies than IBM was. So I got this idea that I needed to be in this parade and not watch this parade go by, because this is where all the action is, and it's really exciting, and this, all these startups and this kind of stuff. And I call it was like my own little bubble of IBM, because I had no idea there was a dot-com bubble happening. And for your listeners that are familiar with, classic movies, American movies, we have Animal House with Jim Belushi, and at the end of this movie, they're in this parade, and it goes haywire, and because of these crazy antics, the band ends up going down this dead end alley, and the comedy of it is that they're all bumping into this wall, and they're just like piling into this wall. Well, that was the parade I felt I had gotten into in January of 2000 when I left IBM to go get it, because I had this client and I was going to go raising money. I was going to become rich and famous with this incredible piece of software. And I learned the first two things happened out of that set the course for the rest of kind of where I am here, the here and now. Three things, let's say. First of all, I discovered angel investors. Only thing I had ever heard of was venture capital and like SBA loans. And so I discovered angel investors because I went to this angel investor group where I was going to see if he should present at it. This client that I was now the head of marketing and this financial person, raising money and stuff. And so I discovered this world of angel investors, which was really fascinating to me, that there were individuals that actually wrote checks out of their own checking account and put this money to work in helping these entrepreneurs. This gap between a bank and venture capital, or your own checking account or your credit card. You're like, they're the gap. They finance the gap. So that was the first thing that I discovered that. And then the second thing was that a great idea does not, I guess, make up for bad CEO. Right. And so, this guy, and it became part of my sort of philosophy going forward. And then on that, because I realized that there were people with money that loved what he had developed. I mean, it was really, really would change the world. And today, there's still no software out there that does it. It was a medical solution, and that would save lives. Like this would have saved lives. But he was, I knew he was difficult, but I had always been able to deal with him because I had IBM behind me, right? And so he would do what I would say. But when it came to talking to and giving up a piece of his company to an investor that told him he could not be the CEO because he would be good in technology and vision, but he didn't know how to run a company. He didn't know how to team build, and he was very stubborn and obstinate, and they don't like people like that. So those became sort of like that became kind of the foundation that set the stage for where I went. I ended up being mentored into that angel group as the Girl Friday, and that I was the Vanna White that would, introduce the companies and all that kind of stuff and do some of the things. I learned all about the angel investing process, interviewed hundreds of angel investors on how they got started, figured out that a lot of them, there was really no education or training or guidance on how to become an angel investor back then. And there still really isn't. And that's, of course, the problem I'm trying to solve with my book, which way it goes. If anybody's just looking at Inside Secrets to Angel Investing, my book solves that as a step-by-step guide on would you, should you, could you. And then, now I'm continuing on developing more education programs and offerings for investors that don't have the benefit of a group that does a lot of that support and wants to be a part of investing in companies and all the different ways that they can invest nowadays and wants to do it with confidence.
So let's get started there. Who should start to invest as an angel investor? You mentioned it's an individual person. So I have savings, and instead of putting it in the stock market, I'm not having a good time right now. I want to evaluate and invest in companies, but honestly, the first thing I think about is, okay, knowledge of the companies. And second, time, right? Who has the time? So, okay, what are the qualifications or filters you should think about before becoming an angel investor? And what do you say in that sense?
Well, time is a big issue for it, right? Because one of the benefits of angel groups is that they usually have committees or they have a structure to screen deals as well as do due diligence before you start to invest, to vet the companies, to vet the management team, to validate what they say is true about their intellectual property, to validate the market opportunity, things like that. Because, entrepreneurs that are in private companies, and I talk about in my podcast I've done, transparency is one of the challenging things that you have in the difference between a private company and a public company, because a public company is obligated by the SEC and they get in big trouble if they aren't fully disclosing and transparent about their financial situations, the risks, the ups and downs, all that kind of stuff. Whereas with private companies, they technically have a document, the private placement memorandum, that's supposed to disclose that. That's the reason why those private placement memorandums are really dry and hard to read, and most people don't like to read them because they don't say anything nice about the company, because they're not supposed to say, oh, we're going to do all these wonderful things and if we get that Microsoft contract. Because they'll talk to you about there's conversations and all this kind of stuff, but they can't say because it hadn't happened yet, right? And there's all these disclaimers on future statements, and individual investors acknowledge that they're taking the risk of, of this may not come out the way you anticipate it can. And that's why there's fraud stuff. And that's one of the things that you look at during due diligence, because if unfortunately, the way it works within the SEC and the private markets is that the only time is when a company fails or does something wrong, or something happens and a group of their private investors get upset with them, file a complaint with the SEC. Eventually, the SEC investigates, and the SEC finds that those founders to have issued fraudulent statements or misleading statements about their potential or their status of their current deal. They said they had a patent, but it was really patent pending, and you made your decision because you thought they for sure had a patent, so it was protected, things like that. Then they will get fined, have to return the money, which makes the company go out of business because they've already spent that money, and they get labeled a bad actor. So you saw when they came out with the crowdfunding, there was this move within the new crowdfunding stuff under Reg A Plus, 506C, and Reg CF, very specifically the exclusion of bad actors in the company. So first and foremost, and in fact, I had a company that had presented when I ran my angel investor group, presented to us, that was unfortunately, one of my investors really liked it. He went off on his own, spent his own money to go deeper into the due diligence, and he found that the founder was a bad actor. They had a previous situation that had happened, and it was supposedly wasn't his fault, but he still, because he was part of the C-suite, he still got labeled that. And so he I think you can't take in investments from bad actors and stuff like that, as well. So it becomes something that is important to consider, but, sometimes people just invest on the emotion. So the first thing I would tell you is you kind of have to you have to figure out, and I talk about this in detail in the book, but you have to figure out what is your amount of your savings or your portfolio that you want to invest, that you feel comfortable if you were to lose it. Like, nobody feels comfortable losing it, but it's not going to, you can always make more money, right? And so, as long as you're not losing your house or your kid's college education or something like that, right? It's extra money you have. And then usually the rule of thumb, and I confirmed this in an event I was at a couple weeks ago, that it ends up being between 6 and 10% of your overall portfolio that you might put into this alternative asset class. So you look at what that amount is. And so if you were to look at, the way people do it is you look at all your assets. You got stocks, you got real estate, you got your money market assets. What does that make up? And then out of that would be, 6%. Some people will say it's like 10% of their liquidity.
6 or 7. Yeah, there is a net like something that is liquid. It doesn't matter. You add in 6 or to 7% of net worth.
It might be 10% of your other stuff, but it might end up only being 3 or 4% of your liquid stuff. And what is that number? And then that will dictate a lot of what you can play in. And then, because most of your regular deals that go to angel investor groups have a minimum investment of at least $10,000, usually around $25,000. But when you get into the direct public offerings of Reg CF and Reg A Plus, you can have as small as like $500, $1,000.
That's what we call crowdfunding mostly.
Yeah.
Right. So let's differentiate that. You're saying, if I want to get in, the first thing I should do is to, of course, decide how much I'm going to invest, and that's going to determine which groups I'm going to go to. And then the other thing is really getting to, you keep mentioning angel investing groups. Why do you keep bringing those up? I knew you were working on one. What's the pros and cons there?
Okay. So the traditional way before the Jobs Act of 2012, and before we had direct public offering, which a lot of people refer to as crowdfunding, and the crowdfunding has mixed meanings to people. So I talk direct public offering because you're directly offering it to the public, but it's not a public offering. Little naming clincher there. But anyhow, so before that, the only way that people received capital was either just because they knew somebody, a friend in the family kind of a thing, or through angel groups. And then and they could be formal or informal groups. Informal groups could be 5 friends that get around at the Denny's and, talk about deals that they like, or they're country club golf buddies or something like that. So there, you have like investment clubs that look at public stocks. Well, you have investment clubs that now look at private cannabis stocks. They have investment clubs that look at different kind of things. So those would be an informal kind of a group. And then a formal group would be one where you have very structured meetings, where a screening process, you have membership fees, you have a commitment, an obligation to invest a certain amount every year, kind of a thing. And so, it's got a very structure to it, right? There and things like that. And the level of the structure can vary depending on the size. Some will have a managing director that's paid money. Some will be all volunteers. But they take it there. And in almost all of those cases, though, they have an obligation of the members to volunteer to be on committees. So, so they're either as a screening or due diligence or planning events or something, right? Getting sponsors, whatever it might be. So the plus of that is that you have the benefit of many different minds and many different experiences coming together to talk about deals and make decisions together. And sometimes they'll make a decision and they'll do this, and then you can always kind of come in for more kind of a thing if you like a deal in particular. So that it's a plus from that standpoint. And and the deals have been vetted, those kind of things. And then but then the downside to that, if you're not, and almost all of them, you are required to be an accredited investor in that, and they may ask you to do that. And for your listeners, an accredited investor is somebody who individually over the last, I believe it's 3 years, has made a minimum of $250,000 in earned income. That's typically your W-2, and has $1 million in assets, not including their primary residence. And then, or it's 350. I usually just go with 400,000 for a couple, but it's, household income with the same sort of thing. It's based off of earned income. And so, and then usually though, they don't have to prove it. They just sort of sign it, but people kind of know, because it also, the requirements of minimum investments, it's not for the faint of heart. Right. And so, so that's kind of the plus there. The downside is that it does take a commitment of time. I mean, they always take time, but it takes a commitment of time in that if you are, and you're usually by location, most of those are only in major metro areas. So if you happen to not live in a major metro area that has an angel investor group, or you find yourself because you're running your own business, or you have your obligations of your job require you to be on the road a lot, or as people go into having families, they have obligations to do stuff with their family, their kids, their, little league, whatever, that kind of thing. And so a group doesn't really fit them. They're the kind of person that they already manage their own E-Trade account, right? They're very comfortable looking at financial statements. They're comfortable making their own decisions, being able to look at reports and make a decision and so in a Reg A Plus world and the portal, so switching over, so that's kind of the structure of the group, right? And you only get the deals that they see. So if you have experience beyond technology and you like other stuff, they may not come through an angel group. Usually angel groups are very focused on the kinds of deals that they look at. And so you won't get the gambit. So like in my group, we were known for being able to do tech and consumer products and, creative things. My criteria was they had to have raised at least half of their initial round before they came to us. And so we would rely on the due diligence of these other structured groups because my group didn't have those kind of committees. We were formal. We had a structure and stuff, but we didn't have committees. And my team did all the screening. And so there was a little bit of difference there, but we would get a lot of really interesting things, a movie or a consumer product that was going through Lowe's, or a new alternative sweetener that had was in 45 stores and was expanding to 3,000 stores, and we're raising, what I mean? We had creative stuff that was a little different that you would never see in the light of day in Atlanta Technology Angels, which was the other group in Atlanta. And so that was the reason why a lot of people liked ours. And I had a lot of those executives and those owners of businesses that liked the fact they didn't have to commit the time. But there's its downsides to that, which is why that angel group doesn't exist anymore. So if you're going as an individual and these direct public offerings, all right, the whole reason why it happened was to open up the opportunity to people that weren't accredited. Yeah. Because when those came into play after the Great Recession, it was in response. Most people think it was in response to giving entrepreneurs more access to capital. And that was definitely part of it, because they didn't have to go through these narrow gauntlets of angel groups. And we had seen how reward-based crowdfunding had really elevated and accelerated a lot of new technology to get into the marketplace that probably wouldn't have gotten into the marketplace if they had been dependent on traditional angels. Things like 3D printers and drones, and even goofy things like the fidget widget. I usually have sitting here as a prop, but smartwatches. Yeah. Smartwatches, all that stuff came to market with millions of dollars that people had done as reward based. And for your audience, that means they got the product early, right? They bought it before it was ready.
It's a Kickstarter model. Yes.
Right. And they would get, but the people that put that money in only got product. They didn't get any equity. So when those companies went on to be successful, those investors, all they had was their widget, right? And so they saw this as an opportunity because so many people had lost their savings and so much of their retirement because of the collapse of the financial markets that affected real estate and the stock market. And it took a decade for people to get back to zero on their real estate holdings if they didn't sell them at that time. If they held on to that stock, 10 years later, you're back to zero. That was pretty much the metrics of how that happened. Whereas had they had an opportunity to invest in this company that might do 4x or 10x their money, you never get that kind of return on real estate and the stock market, right? You don't have that potential return on those. And so it's, not in the short period of time you have with startups. Eventually real estate will become 4 times its worth and things like that, but usually not unless you got a really great deal. But the general rule of thumb. And so it was an opportunity for people to play at whatever level they felt like playing at. And so it was a real aha moment for me when I was listening to one of Jason Kalkanis's podcasts years ago with the founder of Seed Invest. And he, and Jason, if your listeners aren't sure who he is, he's TechCrunch. He is like a known guy in the tech world because he invested in Uber. He invested in a lot of the big ones. And he initially had that money because he had been a successful tech entrepreneur himself. And now he's kind of like a granddaddy of investors out there, the super investor. And so he said if he knew what he knew now, he wouldn't have started his company at 22 years old. He would have gotten a corporate gig, and he would have taken $500 a month, because you wouldn't get matching on your 401k for 5 years till you're vested. So he would take $500 a month and put it into a Reg CF company, just things he knew, things he liked, things he was, not really stressing too much about it because it was $500, because you spend that on, not necessarily on Starbucks, but there's all kinds of habits that people have that they spend $500 a month on, right? You might not be able to buy that fancy, evening bag or something, or shoes, or whatever our indulgences are if you wanted to do this. But you think at the end of 5 years, okay, so you do the math, that's 60 companies you would have invested in. And if you look at just the normal thing that pretty much the whole industry goes by, out of 10 investments, you're going to get 3 that fail, 3 that do, okay, 3 that do pretty good. You make good money on that, at least double your money. And then 1 that hits it out of the park and, makes it up for all the others. So if you go with that out of 60, that's 6 companies that hit it out of the park.
Right.
So now it's 500 investments. So it's not like you're going to make $50,000 on those. But, when you add it all up and you just do those numbers, it's going to be a lot more than what's the math on that? The 500 by 60, so is that $30,000? So you would have invested a total of $30,000 over that period of time, which in general, that's as much as like an accredited investor might do in one, but you've spread it out over lots of different types of companies, lots of different types of things, and you would learn a whole lot about the process in that 5 years, so that in the end of 5 years, with that additional money and with whatever your income has grown over those 5 years in the corporate world, you now very well could be in a position to start playing in the big boys with the accredited investors, right? And start participating or even taking one of your winnings. Because I kind of like, it's like you're out in Vegas, you take your money off the table and now you're running with the house money. And so you take that money and you put that into a fund. So when you don't have a lot of time and so one way is to put it into these angel funds that it's like being in a mutual fund, but it's for angel investments, right? So you could do that where you might put 30 grand in and they'll put it into different investments, giving you the option to add to it if you like a particular one. So those are the kind of ways to get started.
In that case, you're buying into the reputation of the fund mostly, right?
Right, exactly.
Managing it. So tell me one huge success and one huge failure for you as an angel investor.
Well, my huge success hasn't been huge yet, but I believe it will be huge because it's on track. It's just taken a lot longer than it originally thought that it would take. And I co-invested with my angel group. It was one that we had a very substantial angel group out of Boston had already been a lead investor. So we had the benefit of that. And it had figured out how to take RFID tags, which, if your audience isn't familiar, RFID tags are those things like when you go to the store and they forgot to take them off and it beeps when you go out. That's how most people think of RFID tags, and they usually cost pennies because they've got where they're just in a tag. It's not even the thing that comes off, right? And so they just scan it and it turns it off, but it's usually that. Well, they needed, because of a airline project, they had won the bid for was to figure out how to take RFID tags and make them hold a phone book information rather than just a 18-bit code or something, right? And so it became a technology. It's Tego is the name of the company, TEGO. It became a technology that is transforming transportation across the board, but also medical, also manufacturing in like in like in car manufacturing, because they found that this technology could resist gamma rays, it could resist high heat, and it was passive until a scan came to it and turned it on. So it didn't beacon the Department of Defense. They were looking for something because they have a real hard time keeping track of inventory, because when they're in enemy, they beacons and the enemy can know where they are. And so it solved all kinds of problems. But guess what? Chips, you have to sell a lot of chips apparently to make any kind of money. So they had to create the whole ecosystem of selling the development kits and like enabling people to program their stuff. So it's going to be big.
Did you see that coming when you invested, or?
No, we knew the air transportation thing was like a big opportunity, right? Because they wanted to be able to completely know what the maintenance records were on a plane without having to take it out of cycle and pull it into the hangar. And around that time, it had not been that long ago that the thing happened with, I think it was AirTran, where they had some expired oxygen tanks, and all the planes got grounded till they could go in and check every oxygen tank on air, and it cost them so much money. And so they wanted to avoid this. with these Dreamliners, I think was the name of or Dream something was the name of the new plane. They wanted to avoid that by having it. So everybody that manufactured anything on a plane ended up adopting this. So now one person can walk through on the plane and they can say every little thing that you would need to check will sign in and say I'm good or I'm not good or whatever. Okay. So that was one. So I'm still really eagerly anticipating an acquisition in that space. They've just been building value, and because of the supply chain issues, and I think they kind of stalled a little bit, and they'll be back into it here. They've had a problem with COVID and that kind of stuff. And I think the US passing the chip encouragement of building chips here, because China was doing all the manufacturing of chips. And so now they'll bring that into the US, and that's going to really help their game. So I'm very excited, optimistic that's going to happen. The one that I'm not, it had great potential. And I made one of the very first rules of angel investing is do not invest on your gut. Do not make an emotional investment.
Oh, wow. Most
number one rule.
Got to connect to the people and, make sure that and that you.
Yeah. That's the number one rule, right? I mean, when I was first interviewing investors before I wrote the book, and when I was learning about how investors made their decisions, I would ask them, how'd you learn how to become an investor? They said, oh, I invested in a couple of deals and I lost all my money, and then I figured it out what not to do. I'm like, that's horrible.
Okay.
So in this case, what it was I totally let this guy pull at my heartstrings, and I believed in what he was trying to do and the benefit it was going to be. And even though I had like warning signs, and I had that voice in me going, I don't know, Karen, I don't think you should put this money in it. But I was like, oh, how bad can it be? Because I was bridging him to do something that was going to help him raise a lot more money. And then that was going to set the stage.
Right.
But what I didn't realize was that he didn't really have the right software development team in place. I didn't ask additional questions like, how is he getting that developed? And what happened was this group developed it, and then Apple wouldn't accept it onto their Apple list, whatever, for their games, whatever it's called. Yeah. And they couldn't get their thing out there for people. So the people that had even given them money on this crowdfunding thing couldn't get the code. They had to send the code to them individually. And it took him so many months because of the way tables had been written in there and just stuff that could have totally been avoided. But he never really launched properly. And so he would call, oh, I feel so bad. But, I'm the one that still don't have that money in my checking account. And I still talk to him. I still try to advise him to kind of get on track. He's learned a lot. The opportunity is actually still there. And, but because it starts to be one of those things if you've made mistakes like that and you've raised money and you didn't realize it, and reach your milestones and do the things you say you can do, it becomes even harder to raise money later because people are like, I don't know, this has got like a little smell to it. Yeah. What's going on here? And so that's one that, it's like, I was like, oh my God, I just did what I tell my investors when I'm helping them make these decisions. Part of what you have to do in the book, and in the book, they get a resource portal. And then there is a criteria, set your criteria up. And then there's a funnel that you run, or a filter you run your deals through. And if it doesn't meet the score that you set, that says it has a minimum score, your ultimate decision will be on emotion, company A versus company B, which guy do I like best, or gal, which one do I like best? But get to the table of that with objective criteria that they've met this minimum amount, and then let emotion choose that, right? A lot of times you'll have people that will jump in on FOMO, fear of missing out. Yeah. And they'll go, oh, I got to get in on this deal. And because somebody else is excited about it. I did a podcast on my Compassionate Capitalist show on transparency. And it was after the, I forget her name right now, but the big SEC securities violation for fraud for that the blood diagnostic
Oh,
tool,
yes, that woman.
right?
Yeah.
Right. And all these people put money in on it, and even uh uh Draper, yeah, Draper, even the big funds. And they have confessed that they kept putting money into it, which gave it more credibility for other people money into it, because one, they knew that if they didn't put money in it, they would lose it, even though they thought they were going to lose their money. And they didn't want to be embarrassed by the fact they had made a bad investment,
And
because
done
she
this.
would never disclose her patents, and she would not disclose this stuff. She was so non-transparent, which was, to me, was that is such a huge red flag. But so many people jumped in on it because others were doing it. It was like this lemming herd mentality, go off the cliff altogether, and it happens. It totally happens that way. And so the first rule of thumb is that if you get that little voice in the back of your head saying, I'm not so sure about this, then take a step back, start over with your due diligence or your criteria thing on it. Make sure you wait at least another 2 weeks. Never do something that, oh, we got to close in 2 days. Never do the car salesman
Never
thing.
do it. Yeah, the fast and like pressured sale, right?
We'll give you an extra this, that, or the other if you just close in like these 2 days, bridge finance to this next thing. Unless, because I always say, if you're just bridge financing to this really big one, or is to pay the fees of this really big one, why don't they just take it out of their closing?
Right.
Why do they need your money to pay for that? They just take it out of closing.
Right. That's interesting. Great. Oh, this has been a ton of information, Karen. I really, really like it. I just want to close with, what do you define as compassionate capitalism? Okay, so I was, intrigued by that.
So I adopted the term, I'd heard it in a different context before, and then I adopted it during this Great Recession, because, as I said, my angel investors were sitting on this. They were people that ran their own companies and stuff. So their money was sitting on the sidelines. And I was like, the best way for you to impact the economy and turn this thing around is to get your money off the sidelines and invest it into these entrepreneurs that have the ability to create new markets and create jobs and create, and fuel our economy. And so compassionate capitalists became somebody, yes, you want to make money. And capitalism is, buying low, selling high, right? You buy something, you create something that has value in the market, and you sell it, or, at a profit, and you make capital, and that's capitalism, right? And then I define compassionate because you can buy and sell real estate, you can buy and sell stocks, right? And make money. But the compassion comes because you're deciding to put your money at work, bringing innovation to the market, creating jobs that ultimately create wealth for all those involved. And so that is a different way of looking at it. So unlike conscious capitalism, which is more internal to the way you run a company and how you treat your employees, how you treat your vendors, your partners, what you impact your community, that's conscious capitalism. That's another kind of a thing out there. Compassionate capitalism in the compassionate capitalist movement is all about, investing time, knowledge, resources, money into entrepreneur endeavors to bring innovation to the market, create jobs, and create wealth for all those involved. And for those executives out there that go, oh man, I'm so bored with my job, I don't know where I'm going to go after this, I'd have to change companies to get another, higher level job, whatever, right?
No.
Don't quit your job to go start a company. Don't do it. The new midlife crisis has been, oh, I'm going to go quit my job and start a company. I'm going to put my college kids' education at risk. I'm going to, I'm not going to have an affair and buy a new car. I'm going to go and start a startup. And something I think I know, and it's a lot more work than any of those executives ever imagined, to start a startup. Even if you acquire a company, a lot more work than what you have in your good job. But what you can do is turn on the passion of the things that you're interested in by investing in a company that shares your passion. They're solving a problem in the world that you also are really interested in. And so it has become the passion of a company is compassion, and be that capitalist that invests in that company. And it's amazing because I saw it, that one Tigo I talked about. When we would do the follow-up meetings, these guys that were like the guy in my book, I have a story in my book telling this, and I remember he was a CEO of a company that was a US subsidiary of a foreign-owned company, and his only option was to move overseas or go look for a job in another company. And but he had the cushy big vacations and kids in private schools, and take off on Friday to go golf and all that kind of stuff. He had never heard of angel investing because financial planners don't talk to people about angel investing.
No, because it goes out of their
right. It's considered selling away, right? Which is a big myth, but anyhow, they have that, and they just don't talk to them about it. And usually accountants don't and stuff, right? They'll talk to you about how to buy a company and what you need to do that, but not on how to invest in private companies. And so he had heard about this. He got my precursor to the book. He started coming to these meetings. You should have seen him when he'd walk into these meetings after we invested in Tigo and these other companies. They walk in, he brought his VP of marketing in, he started getting them to be angel investors, and they'd have this sort of like this bravado where they would be like, yeah, I invested in this hot new silicon based RFID tag company, right? They are like everything you just see it. The swagger was just, they just had an energy about them, excited about what they were doing, the impact they were having with these companies. And so that's your midlife crisis. All you listeners out there that, you shouldn't have it when you're 25, but if you're having a career identity crisis.
No, don't have a midlife crisis at 25. I completely agree, but yes.
Yeah, but you have a career
identity at 50, just go and become angel investor.
Right.
Yes.
Keep your benefits, keep your perks, do the job, create your hobby. And this thing, a lot of people in that millennial age jumped on the Bitcoin, thing, right?
That's a topic for another podcast.
Yeah. Angel investing is not near as risky as Bitcoin.
Yes.
Okay. It's not near as risky.
Yeah.
And you get to, you're having tangible impact on these companies when you do that. So there's all other kind of things you can do to mitigate your risk and be more comfortable with your decision. But that's really the framework of it all.
Thank you so much, Karen. It has been a great pleasure. I hope to maybe someday have you again soon.
Yes, I'd love that. Yes. And please, folks, if you're interested in getting the book, go to Inside Secrets to angelinvesting.com, or you can also find it on my website, Karen.
I'll put it on the show notes. Yes.
Great. And join the Compassionate Capitalist movement, everybody. Let's make this thing happen.
Thank you.
Thank you, Alondra. I really enjoyed it.